Strong US data, a patient Fed, and booming equities are putting pressure on gold. But is that the whole story? Beneath the surface, structural forces may be laying the groundwork for a solid floor. Let's break it all down on this week's episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Actually, gold saw a round trip last week, rallying early on, only to reverse as strong US data, a cautious Fed, and continued equity inflows dampened its short-term appeal. At the moment, bears appear to have the upper hand. With that said, the bigger picture still looks quite constructive. Structural drivers such as rising fiscal deficits, inflation risks, and tariff uncertainty continue to support demand for gold as a hedge. This week, markets will be closely watching developments around US tariff talks and any fresh comments from Trump. This could serve as near-term catalyst for price movement. And from a technical perspective, gold against US dollar rebounded early last week, reclaiming $3,300 and the 50-day moving average. But momentum faded quickly and sellers returned by Thursday. Prices are now retesting the $3,300 support zone, and a clean break below could open the door to $3,250, the May and June lows, while on the upside, if bulls regain control, $3,400 becomes the key level to watch. Well, in my view, the recent weakness in gold is largely due to a combination of three factors: solid US economic data, the Fed that's in no rush to cut rates at all, and a strong equity market that continues to attract capital away from defensive, or actually I should say, safe haven assets. The June non-farm payrolls report came in better than expected. 147,000 jobs were added versus a consensus of only 105,000, and the unemployment rate fell unexpectedly to 4.1%. While wage growth was slightly softer than forecast, the data overall pointed to a soft landing scenario. Not weak enough to raise recession fears, but not strong enough to stroke any fresh inflation concerns either. And following the report, markets sharply dialed back expectations for a July rate cut, with odds falling from around 25% to just 5%. But still, investors haven't ruled out the possibility of 2 cuts by the end of the year. This kind of shift in risk expectations has a mixed impact on gold. On one hand, delayed cuts reduce the metal's short-term appeal as a non-yielding asset, but on the other hand, greater uncertainty around the policy path adds to gold's medium-term attractiveness. At the same time, fiscal policy has shifted into high gear. The One Big Beautiful Bill passed Congress, extending 2017's tax cut and lifting the debt ceiling to $5 trillion. This could push the US deficit to over 7% of GDP. While this may support near-term growth and lift equities, it also raises concerns about fiscal sustainability, and that's where gold's role as a hedge becomes more relevant. And meanwhile, central bank demand continues to offer a strong foundation. The PBOC has added to its reserves for 8 straight months, and many emerging markets are treating gold as a strategic de-dollarization asset. This kind of structural demand can help cushion the downside, especially if confidence in US assets weakens even slightly. While looking ahead, today marks the end of the 90-day tariff pause period. While Trump has delayed implementing new tariffs until August 1st, what markets are calling another taco move, there's still a 3-week window where trade headlines could influence sentiment. And if tariff talks somehow turn more confrontational, it could boost safe haven demand for gold. So all things considered, gold remains under short-term pressure around the $3,300 level, weighed by strong macro data and robust risk appetite. But beneath the surface, rising physical risk, steady central bank buying, and policy uncertainty in regards to tariffs and the rate cut path continue to build a supportive mid-term backdrop. And personally speaking, if the $3,300 hold, I view any near-term pullbacks as potential buying opportunities as always, especially as we head into a period of heightened event risk from the trade developments to key inflation data like the June CPI coming next week, also two non-farm payrolls report before the September FOMC meeting. All of these could shape expectations for a September Fed move. So that's pretty much all for this week. If this video is helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events and data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!